to the second edition of the LPA Training Academy, and good afternoon. First of all, we wanted to thank you for joining us, for your interest, and also then for you to attend either this module or the entire program with us over the entire month. We certainly also wanted, with the LPA team, Avi and I, to thank our different contributors, experts who made this program possible and who will be then with you each day over lunchtime. Certainly, I wanted to highlight a few new elements of this academy. For example, we have been accredited by the Ministry of Education, and we also now part of the Lifelong Learning Network, and some CPD points will also be distributed at the end of certain modules. So now I will pass over to Avi, who will drive you through our program.
Thank you, Stefan. So welcome everyone, welcome Jerome. I will just update you quickly regarding our new program. We have a combination of existing and new modules. Of course, we have our VC module by Expon Capital. Then we have our ESG module by LuxFlag, our new tax module by Atos. It's following our private equity foundation with Cyril de Maria. Then we have a new private debt module by Cordet, Elvinger Hoss, EY, and IQEQ. And in the end, of course, we have our Legal Academy by Allen and Overy. So I would like just to remind you that in the end of every course, you will receive a survey and, of course, access to the recording sessions. And furthermore, to encourage you to be interactive during the modules and ask your question by using the chat function and also by using your camera and microphone. And of course, to ask you to rename yourselves with your full name. So back to you, Stefan.
Thank you, Avi. So now we will move on to Jerome. Jerome Wittmer is an ExCom member of the LPA. He's also a former chairman. He's founder and managing partner of Expon Capital, and I would warmly recommend you to have a look at our YouTube webinar, or rather interview, the Luxembourg Private Equity series with him. It was very inspiring, and we also have now some podcasts. So first of all, good afternoon, Jerome. How are you?
Good afternoon. Thank you, Stefan. I'm doing great.
Fantastic. So welcome, and the screen will now be yours.
Thank
Enjoy.
You. Thank you. Enjoy too, I hope. All right. So do you see my screen?
Yes. Yes, Jerome. Yes. Yes.
Wonderful. Wonderful. So hello, everyone. Very thrilled to be here with you today and to share my passion for venture capital. I'd like to extend a warm welcome as well, a special welcome to the winner of the Expon Scholarship, Armin. Really warm welcome, and really glad that you made it. The other winner, unfortunately, apparently she's not been able to join today. But I hope she will be able to do that in the future. So indeed, in terms of the rules of the game, I like it to be a little bit interactive. Otherwise, I'm like alone behind my screen. I understand it's not necessarily easy, but there is a chat function. I don't know if I'm going to see the chat, by the way. But I don't know, raise your hand or something, and I guess I'd see something. So, and there's no bad, stupid questions. There's only a very bad, let's say, teacher that's not clear. So I hope I'm going to be at least clear enough most of the times. But if I use some jargon or I'm not clear enough, raise your hand, and I'll be happy to answer your question. So I hope you're really super committed and concentrated, because this is going to be a deep session, and it's going to require a lot of your CPU time for the next hour and a half. So let's dive into it. So I'll just pass over that. I guess the reason I'm here today is because I have a bit of experience in venture. So what is it that I do with my partners at Expon Capital? Well, we back exceptional founders such as Peter, Jeroen, and Joel here on the picture, who are solving really hard, valuable problems using digital technologies, and that is to have a meaningful impact on the world. So we are really a venture that is doing investment for good. And this was Spire, by the way, which is a company headquartered here in Luxembourg and operating around the world. So our angle to investing is, okay, what are we trying to accomplish, right? And of course, the number one thing is money, right? And we're going to be talking about money for the next hour and a half. So I think that there's another layer to the money, and one which is very dear to us, and you can see it here through the icons on the screen, is the United Nations Sustainable Development Goals. If you look at the needs of the populations on this planet for the next decades to come, or the next, and they represent a multi-trillion euro opportunity. So we think that we absolutely see this as the way to invest, the way through which any investment analysis is made, rather than just to, okay, let's go and make money and not think about the consequences. Here's a portfolio overview. I'm not going to go through this, just to show you that we're highly diversified across B2B and B2C and B2B2C, from companies in Europe to Israel to the United States, and some of which have become pretty high profile. We sold Glows to Medium a few months ago. We sold Verse to Square, which is a New York Stock Exchange listed company. So it's going pretty nicely. And we have one unicorn already there, which is Glovo, and we think we have 3 more coming up with a couple of IPOs that are being prepared as we speak. So another, let's say, example to inspire a little bit the conversation here is Spire, in which we invested 3 years ago. They are a data company, but in order to become a data company and create the world's most advanced weather modeling forecasting system, they've had to launch over 120 satellites in order to get the data, because nobody else had that data before them. So what they can do is not only charge their customers, which are mainly governmental customers, many millions of dollars every year for the services, but ultimately they're able to save people's lives, which is a pretty nice bonus, I think you will agree. And they're transforming, many different markets. So we really like this kind of investment because it's really a platform business with different services, and they're applicable across many different kinds of industries. So really a platform type business, which we think this is also one of the unicorns and potentially a public company, hopefully end of this year or next year. Another one is Catalyte. Catalyte is a US-based company based in Baltimore, where everybody's talking about, the reskilling or the upskilling of the population. People, in their 40s, in their 50s, sometimes even younger, have studied for a certain type of job that no longer exists, or that still exists, but let's say is going extinct due to AI, automation, robotization. And we need to find, a solution for these people. And this is what Catalyte is doing. They're getting rid of the CV whenever they hire. They don't want to see who is behind, if it's, young, old, any color, any gender. They don't care. What they care about is the skill set. And so they test people, and on that basis, they recruit them, they train them, and then they resell their capabilities to big corporate customers. So we're really very, very proud to be an investor in this company. Our agenda for today, which I told you is a pretty strong one. First, we'll go through return probability distribution, diversification, VC strategies, fund economics, and then co-investments, and we'll close by talking about the relationship between VCs and family offices. All right, let's start with the VC return probability distribution. What the hell is that? Well, I'm going to tell you. So first, let's start with a sort of a question, and let's see if I can minimize the screen here, right? So let's imagine that you invest €1 million in a startup, right? And so the kind of question you want to ask yourself is, what is the probability that I will lose 100% of the million I invested, right? What is the probability I will make my money back? What's the probability I will double my money? What is the probability I triple my money? Okay, and that's the easy way to think about it, because of course there's a temporal dimension to this, but already simply at that level, you can see that this is the sort of question you want to get an answer to, right? I can't move the slide. All right. So I guess all of you are familiar with the ghost curve on the screen. It's the kind of probability distribution that is quite prevalent throughout the environment, in society, human population, for age, for IQ. And so, for instance, for IQ, on the left-hand side, you have the people with very low IQ, on the right-hand side with a very high IQ. And most of the population sits really, you know, in the middle, right? So that is how the population is distributed. Now, in terms of the venture capital return, is this what is happening? Well, the answer, you guessed it, is no. That is absolutely not the way venture capital returns are distributed. So the question is, how are they distributed if it's not in a normal way? Well, the word we use for the distribution of venture capital returns is called the power law. The power law means it looks like what you see on the screen, with the probability on the left axis, probability starting from 0 at the x-axis and going up, and the return on the x-axis starting from 0, you see, to 10, and of course to infinity. What this says is the probability of doing 10x or 100x or 1000x is very, very close to 0. And you have a very high probability of doing less than 1. Actually, you see that you have a greater than 90% probability, I don't know, not even actually 98% probability of doing less than 1. This is what the power law is saying, all right? So of course, what you're seeing now on the screen is just a mathematical representation of the power law. And it always depends on, okay, what do you put into the parameters of the equation so as to, you know, create that kind of curve. So I'm here, I'm not just suggesting that the power law is exactly like that. What I'm suggesting is it has exactly this kind of shape, all right? So in practice, if we look at the distribution of exits between 1995 and 2016, so which is a pretty long period, 20-year period, it gives you a pretty good idea of the distribution of returns and of exits. So on the, again, on the left-hand side, you can see that broadly 40 to 50% of both enterprise and consumer companies, when they're exited below $50 million, right? So half of the companies sell for half of $100 million, so less than 50. Of course, as you can imagine, most of them sell for even less than 20. So On the other end of the spectrum, on the right-hand side, you can see that there's around 6-7% that sell over $1 billion. And in between, you have what's called the long tail. So the more you go from the left to the right, the less you have occurrences of exits at those levels. So if we take, you know, I don't know, from 600 to 650, we are at around 0.8 to 1.3%. So extremely low percentage probability of exiting in that bracket. The good thing is that the data dates back to 2019, I think. Since 2000, the tail that we were just showing just before. So the tail is what you have between the let's say the 50% on the left-hand side and the top exit on the right-hand side. That's the long tail. And that tail used to represent 60% of the industry returns. So out of the largest 10 outcomes, which are on the left-hand side. And the number is growing. So which means that the shape of the curve is staying the same, but it's getting fatter in the middle, which is a very good thing for the industry because it means that we can generate higher returns, at least higher exits, not necessarily returns, higher exits above $50 million, which is arguably a very good thing. Now the power law, again, we can try and visualize it in different ways. And as I told you, depending on the kinds of parameters and the kinds of visualization, it takes a slightly different shape. So here we use the log normal mathematical representation, and we can see that there is a slightly improved death rate in this case because the power law that I showed you was giving a pretty stark picture of the death rate, as you can remember. I think was like 98% failure rate, and of course it's a bit better than that, indeed. So I'm going to use this quote by Mark Andreessen. He's the founding partner of Andreessen Horowitz, pretty famous venture capital firm that was created in the 2000s. And he explains, you know, the reasoning. And I'm just going to quote him. In 2016, there were about 4,000 startups a year in the United States founded that would be raising VC. And they, at Andreessen Horowitz, could invest in about 20 out of the 4,000. They were seeing about 3,000 of those per year, and they would narrow that down to a couple hundred that they would be, you know, spending time on and meeting and really analyzing. Because, as you can imagine, you can't possibly you know, look at every deal with the same type of intensity. And honestly, not all of them are interesting. About, as he says, 200 of these startups a year are fundable by top VCs. Fundable, it means that they have a story that is compelling enough that you would want to invest because you think they have the potential to drive the kinds of returns you're looking for. And he finishes by saying that about 15 of those will generate 95% of all of the economic returns. And even the top VCs write off half of their deals. So you can see the sort of mathematical, let's say, and practical approach that there is to the power law distribution. A lot of companies, very few that have the potential to generate the outsized returns that venture capital is seeking. So what is the first takeaway here? Let's imagine that in the world, there's about 100,000 new startup opportunities every year. It's about the right sort of you know, number in reality. So what are the odds that you're going to find the 100 that are going to outperform? And the corresponding question is, can anyone and everyone be successful in VC, right? I think these are important questions. And I'm not going to answer directly those questions. I'm going to let you, think on the basis of what I've been sharing with you and what I continue to share with you in these next slides. So on this slide, what I'm showing is that the odds of winning means that we need to see the very best investment opportunities. And not only that, we need to have the ability to spot them, right? It's not only that you get the opportunity, you need to know that they are the ones, right? Especially when you see 4,000, if you pick the wrong ones, you're going to lose the money. So here in this case, when looking at the chart, you can see that the number of startups starts from 0, it's at the bottom, and goes on the right-hand side towards 2,500. 80% of them are never going to get past the seed stage, which means they're going to raise 1, 2, 3 million, and they're never going to be able to raise a Series A of, let's say, 5 to 10 million. They're not going to get there. So what it means in most cases is they're going to go bankrupt. On the left-hand side, you see the valuation, and the valuation, of course, increases past the seed stage to Series A and Series B and Series C. And you see that only 3 startups in 100 will reach about €100 million valuation. So obviously, what venture capital firms are seeking is not only 100 million valuation, but they're seeking the 1 billion or 5 billion valuation. What is striking is what I put in the red box on the right-hand side, is that if you look at what Facebook has done at the time of its exit, the capital gains generated by the VCs that have invested in Facebook are superior to all of the capital gains ever generated by all VCs in all venture worldwide forever before Facebook, right? So this puts into context the power law, right? One company is going to provide more capital gains than all of the other companies in the history of venture capital for all of venture worldwide. That's the kind of dynamics we're talking about, right? And of course, they don't happen, the Facebooks don't happen every day, but it seems that we're seeing an increasing occurrence of those opportunities. So now that you know what the power law is and how it works, what does it mean for your portfolio strategy? Now that you know that, and you have to think about, okay, I'm going to create a venture capital portfolio. What do you do? Anybody has an idea what you would do? And I don't know if I can see the chat box here. Can I see the chat box somewhere? I'm checking the chat. Yeah. No, there's nothing. Sweet. I have a shy audience today. All right. So I'm going to give you a clue. No, it's not even a clue. It's the answer is you need to diversify. There's a diversification is the answer to the power law distribution, right? So we're going to talk about venture capital portfolio diversification now. Why diversify? Well, Harry Markowitz, Nobel laureate, said the only free lunch in finance is diversification. You can reduce the sort of risk you're keeping while still keeping the same level of expected return. This is absolutely the foundation of diversification, and this is how you're going to address the challenge of the portfolio, right? So what is diversifiable? Of course, there's systematic risk, and systematic risk is not diversifiable. There's, you know, the risk that a specific company is going to fail for specific reasons. Of course, that is not something that you can diversify away from, but you can diversify from unsystematic risk, such as by investing in both early and late stage. So you're going to decorrelate things. You're going to invest across different sectors which don't necessarily have a correlation, like for instance, food and I don't know, retail, clothing, e-commerce. They don't move in sync because everybody needs food, but you don't necessarily need clothes every day. So they're decorrelated. So you diversify away from clothing when you invest in food. The industry beta, of course, is going to be different from one. For instance, food is going to have a much lower beta than travel, and that will smoothen out the volatility in your portfolio. By concentrating investments in one country, like everything in Germany, of course, if there's something that happens in Germany, like you know, a pandemic crisis in that country, but not in the others, of course, you're in bad shape. So going international is going also to provide you with, you know, a cushion and some diversification. Developed and emerging markets, taking account ESG risk, of course. I mean, some firms are, let's say, polluters, or they don't take into account you know, the community, the stakeholders, and you don't want to over focus on these types of companies, right? So why it matters in venture capital? So with a small number of investments, your chance of a winner is too small, and your bets are going to be too concentrated. So you need to place enough bets, right, to expose the venture capital portfolio to outside successful companies. That's a direct consequence of the power law. So if we look at the source of size portfolio, again, this is a simulation and not an exact representation of reality, because it depends if you invest in early stage or in late stage. In early stage, there is a high risk, so you need many more companies, and that's at the bottom from 0 to 300. That's the number of companies, and on the y-axis from 1.2 to 2.6 multiple of the fund. So what this shows is you have a higher probability of having a higher return when you have enough companies in your portfolio. So what is a bit provocative here on this slide is, of course, that what it shows is you need sort of to have at least 100 or 200 companies in the portfolio. Well, that is let's say a bit exaggerated for sure. Now it probably applies more to seed stage investments than it does to late stage and growth venture, which do not present the same level of risks, because the firms have proven that they have you know, product that works, there is product market fit. They have proven in some cases that, you know, they can scale and the distribution recipe works. And so they're able to lower the operational risk that they're going to become bankrupt. And so in those cases, you don't need you don't even need 50 in your portfolio in order to do 2x or 3x. But of course, too much diversification could be detrimental, right? Because in practice, we have to work. Just a second, please, because I have a visit here. That's when you're live, right? Yeah, we do actually have to do some work, right, for each of the investments, not only pre-investment, but also during the holding period. We need to manage those, right? And managing those takes a lot of time. Already in the analysis phase, it takes an awful lot of time to create the relationship and create the sort of level of confidence and comfort that you have by investing in other people, right? So at Expon, for instance, we invest in much more concentrated portfolio, and we balance the sort of bar low risk by spending a lot of time, disproportionately a big amount of time, reducing the risk by understanding the companies and the teams with which we're going to work. So of course, we still have, there is a risk that whenever we spend time, we're not going to do the deal. And so we effectively put money and our time down in the trash because we end up not making an investment. But at the same time, we end up avoiding issues as well. So what I can tell you is that some investors we know have developed a Tinder-like app for making investments. The investor I'm thinking about, they have 40,000 investment opportunities every year, which is extremely large. It's almost half of the world's opportunities that they see. And there are 4 people on the team. I think there are maybe 5 now. So you can imagine that they don't have the capacity to spend time. So they have a Tinder-like, app. Swipe on the left, you don't want it. Swipe on the right, you are interested in investing in it. And that's how they end up investing effectively, not spending much time at all in the analysis and not spending any time at all in the portfolio management. Of course, this is totally in sync with the power law, but they're going to end up with a portfolio where they have 90% of the portfolio that is going to end up worthless. And so they heavily depend on finding those disproportionate outcomes. So, of course, I had to bring Warren Buffett in here, which is, and he's saying exactly what I was saying, and which is the opposite of what was said before. So wide diversification is only required when investors do not understand what they're doing. It's provocative in some ways, of course, but it's always a choice, right? You know what, when you see the power law and you understand what it means, you're able to position yourself on the power law and say, okay, this is what my angle and this is what I want to do. It's very difficult to beat the power law, but when you actually spend the right amount of time by focusing on reducing all the risks, in the end, you end up being, I think, a lot more efficient. And you can't do that, of course, if you spend your time on a much too large set of opportunities and companies in your portfolio. So some investors, such as Seeders, such as Techstars, they have hundreds and hundreds of companies in the portfolios. I think they're making easily 100 deals every year. So there's 52 weeks. That means two deals a week and no holidays. So imagine what it means in terms of the ability to know what you're doing. You have, let's say, a bit of a hunch that this is good or this is bad, but you don't actually really know, and you're going to end up with a lot of casualties. Now we come to the next logical step. When you know what the probability distribution of return is, that you know that what diversification can do, you can start about thinking about the strategy. So I decided to show you here what the landscape is, right? And At the bottom, you can see that, you have love money, so that's pre-seed, it's called pre-seed these days. Then you have seed money, you have seed 2 sometimes, or pre-series A, and you have pre-series A, you have series A, you have series B, series C, and of course it continues to, the alphabet is a pretty long one. It rarely goes to beyond H, though. I can't say I have seen much of that. Though we have a series Z, we own some series Z stock in an American company, but it doesn't mean that there was, the 26 letter in between. So the approach can be either you're going multi-stage and you're going to invest from early to late stage, or you're going to say, okay, no, I want to focus on early stage. And in early stage here, I put it as covering both from the love money to Series A. And actually, you have some VCs that say, okay, no, we actually do only seed, or we only do, seed to pre-Series A. You understand the picture. You can, whatever the strategy you want to do, you can decide to focus on a narrow set or on a wider set. Or you can focus on late stage, of course, and Series B, Series C. Each decision has consequences on what you do, how you do it, on the size of fund that you have. Some people say that the size of your fund is your strategy. I would tend to agree at least partially with that. And venture, of course, is about investing in equity or quasi-equity, because a lot of people are, founders are trying to sell what is called SAFE these days, so simpler agreement for equity. That was invented by Y Combinator in the US as a way to, simplify the early stages of investments. So, and this is, of course, this came to Europe 5 or 6 years ago. It's not the preferred way for most VCs because there's a lot of things that don't work with safes, but they're a thing to to deal with. There's many things to say on this slide. One of which is that each and every stage is about answering questions, right? So the first question for at the love money stage is, okay, what is it that we want to do? The second question at the seed stage is with who? What is the team, and how can we build, the first prototype, and how is it going to look like, etc. And then it's really about, confronting that with the market and seeing, okay, well, is this what the market wants? And is this the sort of price that people want to pay for what we have produced? And then Series A is starting to scale. It's starting, so we have a product, it works, people like it, they're ready to pay for it. You still don't necessarily know all of the, let's say, you don't have all the answers because you don't necessarily know how much each and every segment of your target market is ready to pay. And these are still questions you need to answer during the Series A stage. But it's the stage where you focus on talking kitchen, chef, a recipe, and you need to define, okay, how can I make this recipe for 100 people, 300 people, 1,000 people, right? And you need to become very efficient at producing your recipe, operationally speaking, for an increasingly large number of people. And that's what how do you make the recipe and the process to create the food in such a way that it's going to be efficient and you're going to be able to scale. And then Series B is you've answered all these sort of questions, the recipe, and then it's about, pushing the throttle with a lot of money and replicating the recipe on a much larger scale. So your McDonald's, your first McDonald's work, and then you're going to open 1,000 McDonald's because you have ironed out all the processes and you know how it works. And Series C is you go global and it's not 1,000, but it's 10,000, right? So that's the let's say the spectrum of strategies from a development stage perspective. Then there is the sectoral or non-sectoral approach of generalists on the one hand, which say, okay, I'm going to invest in tech, and this is what I do with my firm. And you have specialists that are going to focus on something specific. So the reason we decided to be generalist is because we've been doing that for more than 20 years now, in our previous lives as well, because Expand Capital is not 20 years old, it's 5 years old, well, almost 6 now. And it's a bit like in fashion, you know, one year you have, you know, baggy trousers and crop tops and so on. And then the next year it's skinny, it's long, and instead of being purple the previous year, this year it's going to be, you know, yellowish. So following trends is very complicated because LPs, or the investors in venture capital funds, they're going to want to see that you have found a recipe and that you can carry it forward successfully over time, right? And because if you said, okay, we focus on, let's say, clean tech, you know, in 2002, 3, 4, there was this big clean tech trend. It didn't end well. It didn't work. Of course, for the young people among you, you don't know this or you don't remember this. And now clean tech is very much back. We don't call it clean tech anymore because it became a curse word. But the point is, it was fashionable at that point in time. And then it became out of fashion. So by being a generalist, you can avoid not being out of fashion because you're going to invest no matter what the type of shape or color, you're going to continue with your strategy. So what you need as a generalist is a strategy that is going to transcend all these fashions, all these momentary trends, right? And the specialist funds, of course, they have some advantages, which is being, you know, it's like being an AI fund in 2020, or I'm sorry, a COVID fund in 2020 that's going to invest in vaccines. Okay, this is the right time, right? But the problem is in 2025, how do you, you know, tell your investors, well, I'm going to go do a COVID fund too? And probably they're going to be fed up. They will not be interested in funding you for COVID too. And there's many examples of that funds they have not been able to, you know, convince investors to invest in something totally new that was not linked to what they had done before, because investors are very conservative. So here is a slide with the sort of spectrum of possibilities. You have development stage from early to late stage. Index venture is investing from early to late. You have inside venture partners, they're definitely very late stage growth. In early stage, I would say you have backed VC in the UK, for instance. There's so many that focus on very much on a specific stage. Then you have the ones that focus on a sector, and such as Point 9, which is investing in SaaS only businesses, or Blackfin, which is investing in fintech only. So some of them focus on a geographies, like First Momentum Ventures, they're focused on Germany, or they focus on a region like Europe, or they go global. And some of them have a theme like impact, and some are corporate VCs. In those, some are strategic and others are financial. So Intel Capital, for instance, they're definitely financial. They're first and strategic second. They're probably the most astute, the most seasoned, and well-invested corporate VC in the world. It's the very best story. If you're interested in corporate venturing, have a look at the story of Intel Capital. That's really the most inspiring out there. At X1, we decided to focus on late, but do a little bit of early. We're not sector specific, as I told you, and geographically we focus on Europe, but invest in the US and Israel. So as you can see, we keep a lot of optionality. We don't close and narrow down the spectrum of possibilities too much, because the more you narrow the possibilities, the harder it is to find the ones that are going to have great outcomes. Remember the power law again. Imagine you reduce the set of opportunities. At the same time, you're going to reduce the capacity to find the outliers out there, right? And we're, by the way, we're definitely a fund that invests for impact, as I hinted at the beginning. So how do you do your portfolio strategy, the model construction? There's different ways, different approaches, depending how you think about the different chapters I told you about. There's some investors that do deal by deal. There are not many, but you do find them around. I think there's one in Luxembourg that does that. Then you have the focused approach, Peter Thiel approach, as I call it, and he says there's typically any time in the world, there's not more than 5 to 8 deals per year that are investable, that are worth our money, right? So it's very focused. Then you have the balanced portfolio approach where you have 20 to 35 focused deals. And this is pretty much the approach that we have. We even have a bit more concentrated approach than that. The shotgun approach, or spray and pray, 30 to 50 or sometimes even more. And then you have the statistical approach that I spoke about, which is very much in sync with the power law. Management style is very different and specific to who the VCs are. We have there's always that questions, and on the internet, on social networks, people ask how are VCs, how do they behave? And I must say it's a very stupid question. It's like asking, how are French people or German people, or, well, you have a range of people. There are 50 million, 60 million, 80 million people. They're all pretty much different, even though they have the same culture. I mean, it's okay, they're VCs, but they're individuals, and they don't think in the same way. They don't operate in the same way. Some people are going to, go out of their ways to help the entrepreneur. They're going to sometimes even go too much out of their ways and get in the company and work with the CEO. And some of them are just going to make a check to invest, and that's it, right? And they are going to call you, hey, I didn't get your numbers for last year, and that's it. So these are the two ends of the spectrum. Let's say very hands-on or very hands-off. And of course, you have everything in between. At my firm, what we do, we're very pragmatic, and it depends on the level of maturity of the founders and whether they need assistance and support or whether they don't. And typically at the seed stage, they need some assistance, they need some advice, recommendations. And of course, at the later stage, Series C, D, E, F, I mean, they're grown. I mean, they're making 100 million, 200 million in revenues. They have a management suite which is bigger than my firm. Do they need us? Of course, they don't. Can we provide some support? Yes, we can. We can make introductions, and that's what we do. But they don't need the same sort of level of support. What is interesting, is the sort of difference between the established and emerging VCs, and how performance is created in a different way by both. I think that a number of people think that established funds are going to outperform, and when you have a first-time VC or fund two of a VC, it's not going to deliver good returns. Actually, it's proven that it's exactly the opposite. Established funds tend to generate less return than the first time managers, and the reason is, of course, who is the most hungry, right? Who's hungry when you're doing fund 10 and you're sitting on 2 billion in AUMs and you're making, I don't know, 20, each partner is doing 20 million just in fees every year. Are you hungry for return? Compared to a first-time VC that has no money, that has everything to prove, for which the management fee is going to be very low, and thus all of the performance is going to sit in the carry. Of course, their interest is to make sure that this is a very high-performing fund, and they're going to raise the next fund. And by the way, second funds do even better because the partners have learned the lessons and mistakes that they made during the first fund. So it's really interesting to invest, I think, in those first generations as opposed to later generations. And I'm not suggesting not to invest in established funds. I'm just saying there's definitely evidence that a good diversification across younger VCs to older VCs makes sense in a portfolio. So another, let's say, drop in the glass that suggests that investing in an older fund does not necessarily generate better returns. You can see Andreessen Horowitz performance over time. So on the left-hand side, Fund 1 in 2009, 300 million, and you can see the Fund 5 in 16, almost 2 billion, and the IRR, of course, is going to be much worse as the company is the company's AUMs have grown because it becomes much more a management fee game than it is a carry game, right? So does timing matter? That's another dimension, and timing is very tricky, and you don't necessarily decide. Time is what it is. If you want to launch a fund and you're ready to launch a fund now, and things happen in the market, are you going to just wait it out for 2, 3, 4 years? No, you just go for it. You can never time markets. And the best recommendation that I've always heard that is given to investors in any asset class is consistently diversify across time. What it means is invest consistently every year in the different asset classes to which you're exposed, and don't try to time the market because the reality is you never know if 1 year is going to be a good year or a bad year. So here are the takeaways of what we've seen so far. I'm not going to, read them for you. You'll get them in the document that you're going to receive because you'll receive those slides. I encourage you to think about these. I know it's a dense session. It's not over yet, and there's still a lot to talk about. Yeah, think about it. Any questions so far, by the way?
If you want, you can check the chat, Jerome.
Yep.
There is a question from Alan.
There's a question in the chat. And where's the chat? Ah, there. Would you say that it is better to diversify in specialist sector are seeking unicorns? or have a mix of knowns and smaller amounts of unknowns? Would you say it is better to diversify and specialize in sectors you know? Or seeking or have a mix of knowns and small amounts? I'm not sure I understand the question, Alan, if you don't mind, rather than seeking unicorns. Okay. Yeah, it's not only about unicorns, of course, and you can make money outside unicorns. The reason why the hunt for unicorns is so important is because that's where you have all of the upside, right? So you're still able, of course, as a seed stage or micro VC investing at seed stage, you're going to be able to make money with companies that don't generate, that do not become unicorns. But the reality is it's going to be very difficult. So you don't want to, let's say, prevent yourself from having the opportunity to invest in a firm that is giving you an opportunity to repay your fund 2 or 3 times, right? I don't know if I answer your question. I hope I did. All right. Well, in the meantime, let me just, I'm sorry, I don't have a glass. Great. So let's pursue. With VC fund economics. So this part requires really a lot of focus and attention. So please bear with me. We have, I think, half an hour left, and it's going to be intense. So here are the VC economics. The parameters are as follows. The lifetime of a venture fund is typically 10 years with extensions, plus 1 year, plus 1 year. Typically you have 2, but you can add as many as you can think of. I think the EIF has a fund that's more than 24 years old, or even more than that. And it was initially a 10-year fund. My partner Alain, he's still in a portfolio that's 15 years old now. So lifetime parameters, 10 years minimum. Management fees, typically 2% per year. It can be 2.5. And if you think about what 2% per year means, because it's 10 years, 2% per year over 10 years, that's 20% of the fund, right? So if 20% of the fund goes to management fees, what does it mean? 80% of the money can be invested, all right? So keep this in mind. Hurdle rate, it's the required rate of return. It's sort of the guaranteed return. In the US, in venture, it's 0. In Israel, it's 0. In Europe, for some reason we don't understand, some investors are still requiring a hurdle rate. The hurdle rate is standard in buyout, so in private equity, but it is not in venture. And there are many reasons for that. I'm not going to go into that for now. In Europe, it's typically something between 1 and 1.5x the money that's been called that needs to be paid in priority to the investors. So as a guaranteed return. The next point is the carried interest, which is always 20% of the performance. And just keep in mind in your head that the average multiple of the fund for 0 carry is 2.5x. So that's sort of the minimum in those conditions we need to reach in order to, let's say, SGPs to get to the point where we're going to get carry. At the minimum average target multiple for the investment we make is going to be something like 10x. So don't be confused by some of the points here. We're going to get into the details. So here is the case study of a real fund called Inside Venture Partners 6. Inside Venture Partners is a very prominent American growth stage fund, growth stage firm that have many funds. They created this Fund 6 in 2007. The size was $1.25 billion, right? The management fees were set at 2% per annum during and after the investment period, so for a period of 10 years. And that's very easy to calculate. That's $250 million, all right? So if the fund size is 1.25 billion and the management fee is 250, it means that how much can be invested? 1 billion. It's easy. Now there's this notion of recycling, and the recycling here in this case was set at 120% of commitments. So what it means is that the money that could be invested by Insight into portfolio companies was 1.5 billion. So how does that work? So recycling means that if Insight Venture Partners 6 is selling is making some exits and is getting proceeds, they have the right to not give it back to the LPs, to keep it and reinvest it. So they recycle, right? It's all in the name, right? So what it does is it increases the efficiency of the portfolio management, right? Because you're able to avoid having this problem that a big part of it is going to the management fee and is never going to be invested. You know, think about it in other terms, is you can invest $1,250 and not all $1,250 is going to be invested in the Apple stock, but only 80% of it is going to be invested in the Apple stock. Well, you know that in order to get back your money, you will need to do I don't know, it's something like 15.6% return to just get to the level of the money you invested, right? So in order to compensate that, the industry has created this recycling mechanism that allows for GPs to reuse the proceeds from exits and to put them back to work so as to compensate for the management fees. The hurdle in the case of this fund is 0%. So what we know is that they have called $1.34 billion from investors for a fund that was 1.25. So it means that 90 million came from recycling, so from proceeds. So they were able to invest more than the money that was committed by LPs into the fund. And the beauty is that they were able to cash out 2.1 billion at the time that I gathered the data points. So if you look at what the cash out plus the remaining value of the fund was at the time, it was 3.159 billion. That equated to a multiple of 2.5x at 30th of June 2015. So that was 8 years after the beginning of the fund, and that translated into a 20% internal rate of return. So in terms of carry distribution, so the performance for the GP, for the VC, equates to $174 million. Not bad, huh? Of course, the reason the figure is so big is because it's a very big fund. And the good news for Inside Venture Partners is that the fund was not yet liquidated in 2018, so they stood to make, of course, much more than $174 million because the remaining value apparently was at least $1 billion more than the $2 billion that are computed in the carry distribution. So they stood to make at least 200 million more. Good thing for them, right? Now let's get into more details, right? By taking an example of a smaller venture capital fund, 120 million fund, all right? And here you can see it starts in 2020, it ends in 2029, that's 10 years later. The first line is the initial investments that the company is making. You see it starts 5 investments last year and ends in 2023 with 6 investments. So, and there's no more investments after. The reason is the investment period is typically 4 to 5 years, right? So in this case, apparently it's 4 years. And the team makes investments every year, okay? And after that, they can no longer make new investments, but they can continue to follow on. To follow on is to invest in existing portfolio companies. So in the first year in 2020, it's the second line, the follow-on, they make one follow-on, and in 2021, they make one follow-on, et cetera, et cetera. And as you can see, they continue to make follow-ons for a number of years, I think 8 years, until 2027. And then the next one is the number of debt. So you can see that in the first years, there's no debt, and then the debts start creeping up. And in the end, out of the 29 investments they have made, there's 17 companies end up being dead. So that's more than 50%. I'm seeing there's a question, I think. What is the basis for the calculation for management fees in VCs? Total commitment, call capital, NAV. All right. So it's a very good question. There's no let's say rule. There's no law, right? It's commercial. For us, it's on commitments. For some people, it's on NAV, and indeed for some it's on call capital, but it's pretty rare. The problem on NAV is you create an incentive for the GP to manipulate the NAV, right? So you create an incentive for them to make sure the NAV is higher than what it maybe is if you apply fair value, right? While if you do it on commitments, then there is no incentive for the GP to manipulate the value because they're going to get their fees no matter what, right? So I hope this answers your question. And the exits, back to the table, the exits start in 2025 and end by the end of 2029. So again, this is a model. This is just a representation. In reality, you have thousands of funds, and each of the funds it's different. In our case, for instance, in our Expand 1 fund, it's 3.5 years old now, and we have almost 3 exits already. So you can see some exits can happen earlier, and we have 1 dead that happened, I think, already in the first or second year, and no more dead in the meantime. So in this case, there's 24 million euro in management fees. There's 90 million left to invest, but thanks to the recycling, 104 million was invested. So 8 million thanks to the recycling. This investor ended up investing in almost 30 companies. Their death rate, you saw, is 17 out of 27. And that's about it. What matters is also the capacity of a team to deploy the money. Doing one deal takes time, because out of every deal you're going to make negotiations and analysis in other deals that are not going to materialize. So one deal actually hides the fact that you spend a lot more time with others. So for every successful investment you did spend a disproportionate amount of time, analyzing and negotiating with other firms, right? And I'm not suggesting it's like 1 to to 10. It's maybe 1 to 1 or 1 to 3. But for us, I think it's more like 1 to 1. So and it depends from one firm to another. And per year, a partner cannot do more than 3-4 deals. It's just, or I mean, technically can. I mean, some people do it, the Tinder way, without even negotiating the terms or looking at or reading the terms. But we do do this in a very professional and careful way, so it takes a lot of time. Let's move forward. So what does it look like if we had a time machine and we fast forward to end of 2029? So let's look at the results. Okay, we had made a number of investments in pre-Series A, Series A, Series B, Series C, Series D, and for an amount of 46.8 million initial investments. So that was 45% of the money was invested in the initial investments, which means that 55% of the money was kept for follow-ons. And what else can I say? And we can see on the right-hand side, the exits. We have 196.6 million euros at exits, and that's 1.9x the multiple of the fund, which is not bad, but not awesome at the same time. So let's look at the table below with the return. And we can see in the first two lines, the first line is dead. So the dead portfolio companies, and the second one is a return of between 0 and 1x. And we can see there's 19 plus 3, so there's 23 investments that represent 64% of the money at work was lost. So again, let's take everything, all the points back. 420 million fund, 80% of the money is put at work, right? 86.6%, including the recycling, that's the 8 million I was referring to earlier. And 64% of the money at work is lost. So that means that 31% of the fund will actually multiply. Multiply means it's going to work and produce some money, right? 31% only. So in order to return 2 times to LPs, the 37 million, which is the 31%, so 37 million must become 240 million, right? That's logical because it's a 120 million fund. If you want 240 million, so it's 2x, the 37 million, which is left, must become 240 million. That's very logical. Thus, you must multiply those 37 million by 6.5x. You see that number, 6.5x, you realize it is very hard to do. There's one more question. If the VC is smaller, has a very wide geographical reach and requires more fees than typical VC, is a 3% management fee justified in your opinion if the duration of the fund is 5%? So the 3 to 4% management fee, it can happen for micro VCs, so very small VCs. 10 million fund, you're going to see it sometimes even closer to 10% management fee. Of course, it's very difficult in those cases to make money, but it's possible. Imagine 10% for 10 million fund, it's only 1 million, and 1 million, that's not a lot of money. If you need a team for a number of years, it's going to be hard, and you can't put 10% every year for 10 years. Otherwise, there's no money to invest. So these types of funds can only be deployed for a very short period of time. So you have 10 million and you deploy it in 1 year or 2 years maybe. So at 2 years, it means 10% plus 10. You invest 80% of the money in 2 years, right? And then you raise money again, and hopefully you can raise a bigger fund. I hope this answers your question. So let's move forward. So how do you get the 240 million back? So let me walk you through each of the steps. Now, remember that the fund will hold stakes of between 5 and 20% of the companies in which we invest at the time of exit, right? Because there's dilution, right? From at the seed stage, there's dilution. I mean, let's say you invest at the seed stage, there's no dilution. You invest, you take 10%, 20%, let's say 20%. At the Series A, if you can't reinvest, you're going to be diluted. At the Series B, if it happens, you're going to be diluted. At the Series C, diluted. Okay, so your stake of 20% is going to go down to maybe 5% over time, right? Those stakes are important. Let's see why. So let's assume the average stake in all the companies in the portfolio is 15%, right? So in each of the company we have in the portfolio, we own 50% of the firm, okay? And let's imagine that all of these stakes, in which we own 15%, are going to generate the 240 million in total proceeds for the fund, okay? So what this means, if we take that assumption, it means the aggregate value of the companies that are going to be sold and exited, it must be 240 million divided by 15%. So that means that the full value of the portfolio, if we look at the price tag of each of the portfolio companies taken together, that would be 1.6 billion euro. Okay. Now let's get to the next step, which is the little table. 6 companies were sold, but 3 of them just gave the money back with a small return. So let's see here. So you can see on the third line, 1 to 2x, 3 companies were sold, but only gave the money back. So, and with a very small return. So let's say 25 million in total. So we need to reach 240 million. We already have 25 million. We still miss 215 million. And there's 3 exits left. One of them is going to do 4x and generate 16 million. It's there, it's written there. One exit is going to generate that. It's on the second line of the first table above, right? And one of them is doing 8x and generates 80 million. And the biggest exit is going to deliver 12x and accounts for 120 million. It's called a fund returner because it's the size of the fund. And so one investment returns the full size of the fund. So, and what this means is that the company, that specific company, has been sold for at least 800 million euros. Why? Well, we have 15%. The 15% is worth 120 million. What it means, 100% is worth at least 800 million. Very logical. So, and of course, this assumes no dilution, right? And so it's probably going to be over 1 billion if there has been some dilution. So I hope I didn't lose you in the process. So this way, you should understand that the anxiety we have as a VC is that we are not going to find the companies that are not going to generate, that are going to generate those outsized returns, right? And that they can pay back the whole fund and generate a very decent return. That's the reason VCs don't sleep at night, right? And that is the reason why VCs say no to a lot of entrepreneurs that have great ideas, because those firms are not going to be unicorns, okay? So, and by the way, this here is just to do a 2x fund. And you should know that doing a 2x fund in the industry is, let's say, it's not a total failure, but you're not going to be, let's say, in the top players by far, right? It's the net. So not very good. Now let's talk about, I don't know if there's any more questions. No. We have a bit of time to talk about co-investments for LPs. So what I'm talking about here is a complex chart on the left with the European Investment Bank, the European Investment Fund, which invests in a fund, and the fund invests in the investee company. So the fund is the venture capital fund, and the investee company is, Kazoo. So the car, second-hand car marketplace. And okay, the GP has the possibility to invest in the company in a new round. Well, they're going to create a special purpose vehicle called co-investment SPV on the slide, and they're going to invite their LPs, their limited partners, to invest in the SPV. We as GP, we keep control of the SPV, and we're going to not charge any management fee. Typically we charge the cost on the basis of the invoice, and we charge a carried interest, which is similar to the ones that we have in the fund. So it's typically 20%, but it can be staggered 10 to 20% depending on the return. That happens quite a bit as well. We have done that on a number of occasions in my firm. Our LPs love it, and the reason is that they have the ability to cherry pick some of the firms that they really like and they would like to create a bigger exposure on. They have the ability to deploy more money than they have invested in the fund. They are going to benefit from a less expensive fee structure because they don't have to pay any management fee. So it's going to drive their return, of course, so they really like it. There is a lot of hindsight, which is the reason is typically when we offer an SPV, I've already invested in the firm in the past. So it's not like a first investment. It's really something, it's a company they already know and that they like. Another benefit is the relationship, because we work much closer with LPs in those contexts. And of course, I mean, they love to have the ability to have these unique opportunities. Nobody else has those possibilities to enter in, typically pre-IPO companies. And they like the fact that there's been a lot of work has been flowed into that. So there's a higher credibility and that the return is going to be made. Of course, there are risks because for LPs, such as family offices, for instance, or even insurance companies or other pension funds, it's a bit taxing in terms of resources, because you need to look at the investment, because it's effectively a direct investment you're going to make, and we don't have time. So not all the time in the world. We don't have 6 months. So it means that as an LP, you need to have the decision-making process that make this a possibility that you can decide within a matter of a week or 2 weeks to make the investment. Of course, another risk is the higher concentration in your portfolio, because you're going to create this overexposure. And there's deal execution is, as I was mentioning, can be an issue and can have a potentially that kind of, the LP is not able to do the work in time once they have said, yeah, we're going to do it, and then it takes too much time, for instance, even to pay in the end. Well, we're at a risk to default, and of course the LP is not visible in this. We as GP are in the front line, and when the firm in which we invest is to which we subscribe is saying, okay, well, you subscribe, where's the money? And we say, well, we don't know. That's a very big problem. Thank God we never had that issue, but it clearly that can put a strain in the relationship between the GP and the LP. Right. Now about the dynamics between family offices and VCs, I think that so we work a lot with family offices on our side, and what we see is so we're entrepreneurs, they're entrepreneurs, we invest in entrepreneurs. It makes a lot of sense culturally. It works really well, and what we like that a lot of entrepreneurial families are very curious. They tend to have a younger generation that is, that loves technology, that wants to, innovate and be part of this technological revolution that we're going through. So I think there's just such a perfect marriage and fit between these two worlds. And clearly, I mean, from what we've seen in the press, family office investment into European startups such as fivefold, there is clearly big appetite from family offices. Now, one of the big questions that's asked is whether to do direct or indirect by going in, investing through funds, and it's always very personal to every family office. There's always this, let's say, the lure for the desire to make direct investments, especially because you have friends that have this idea and you want to pursue it. And we're trying to assist as much as we can families in taking the right decisions. It's not easy. What I can say is we see thousands of opportunities every year. It's our bread and butter. This is what we do. And that's, I think, the sort of challenge for family offices is to have the same level of competency and expertise when they're doing so many different things. And of course, we have the resources. They don't necessarily have the resources to put enough expertise at work because they're stretched short. And in terms of portfolio allocation, also some family offices are, you're making a few investments where, as we discussed, in terms of portfolio strategy, you really need to have a consistent strategy across time and across a sufficiently big number of firms. So portfolio approach is the name of the game, but we're definitely natural partners in this subject. Any questions? We're 1 minute before the end. What a timing. Any questions? And now it's the time to tell me, why were you muted during the last 2 hours?
It seems that you covered everything, Jerome.
Well, very good. I'm very glad I did. So I hope I kept you awake, and I hope it wasn't too hard to swallow. I think Evie is going to tell you you're going to get the material. For those of you that for which this was the first time, I really encourage you to revisit it because it's quite dense. Even for professionals of this trade, I can tell you, it's not everything is obvious. There's no necessarily a straight answer for many things. I see there's a voice questions are also questions. Yeah, voice questions, of course.
So yes, if we don't have any questions, I will tell you that you will receive all the recorded sessions in the end of the module, so after the third session. And Jerome, if you don't have anything else to add, we will see you tomorrow, same time, with Rodrigo.
With Rodrigo, yes.
Yes, for the second session.
Exactly. You'll be in great hands with Rodrigo. You'll see totally different style, but I think you're in for a treat because I think it's an awesome session as well. totally complementary and that follows really logically what we've said today. So, yeah.
So super. Thank you, Jerome. Thank you, everyone. See you tomorrow, same time.
Thank you. Bye.
Very good.
Thank you very
Thank
much.
you.
Bye-bye.
Thank you. Bye-bye. Have a great afternoon.
You too.
Bye.